Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I am going to be looking at Zoom, the video conference platform that became synonymous with talking to people on camera online during the pandemic. And they really benefited from the shutdowns during the pandemic, the work at home movement that happened at that point during the shutdowns. Their earnings basically exploded starting in 2020. We can look at that soon. We will look at their latest earnings, the financials, and kind of do a pricing analysis before we're all said and done. So, hope you enjoy. Please let me know what you think in the comments down below. As always, this video is for entertainment purposes only. Please do your own due diligence before making any financial investments. I am not a financial advisor, just a guy with a degree on the internet doing some talking about stocks. If you're new here, leave a comment down below. Let me know what you think about the video, what other stocks you would like reviewed. Hit the subscribe button. I've gotten a bunch of subscribers from the last couple of videos, so welcome to the channel and hope you guys stick around. Let's take a look at Zoom. Like I said, their earnings have been really flying in the last couple of years, but they are now hitting the skids as some companies start to force people back into the office, which I am not a fan of because I love, love, love working at home. Even Zoom, the CEO said, listen, guys, we got to go back into the office, which doesn't seem like the right thing to do simply because you want to make it seem like your product is amazing and you can foster a community, foster good workers, foster employee satisfaction just by using Zoom. But this guy's saying, hey, over the past several years, we've hired so many new Zoomies, terrible name for employees, by the way, that it's really hard to build trust. So you can't build trust over Zoom. We cannot have a great conversation. We cannot debate each other well because everyone tends to be very friendly when you join a Zoom call. My friend, that is a terrible message to send when you're a company that really, 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 really needs to make it seem like you can do everything you can do in the office on Zoom. Because you really can. I mean, let's be serious here. 95% of the time when you go into the office, you send people messages on an IM chat instead of talking to them in person. The same you would do as if you're in the office. Depends on your job, of course. Certain jobs do benefit from collaboration in person. Other jobs really do not. So really, what's their selling point? Hey, we can have customer collaboration without meeting in person. We can have employee collaboration without meeting in person. We can improve the employee experience without meeting in person, doing that all online in one central app. And that's what Zoom is. They've got some customer wins they're talking about. Operating cash flow is growing. They've got a lot of customers. Zoom Phone, which is their peer to peer phone network, is reaching about $500 million in annualized run rate revenue. That's pretty good. And they're continuing to grow. Total revenue grew at about 4%. Enterprise revenue, which is their big corporations, is growing at about 10%. And that's what you want to see. You want the enterprise revenue become a bigger part of the business versus the less static non-enterprise revenue. Monthly churn is lower than the last quarter as well. Growth in enterprise customers, again, talking about enterprise customers, their net dollar retention, meaning that, hey, when customers renew, they add new services that we may be offering. We're able to increase their pricing and really improve the revenue we're getting from each customer on a scale of about 9% versus what they were before. And then we've got more customers that are actually contributing more than 100K in revenue because these are expensive products. If you look at the plans offerings, you're basically talking about 150 to 250 plus a year per user when you're talking about enterprise use. And on an enterprise scale, when you've got more than 1,000 attendees per meeting, you need something like that. It's even more expensive. So pretty expensive. The Zoom phone service, which they talked about before, is also relatively expensive. Talking about decent pricing, decent revenue, and that's why this is a company that generates quite a bit of revenue per year. The question is, can they maintain those margins? Can they maintain this pricing in the face of other competition? There's also Microsoft Teams. If you kind of look at their pricing, their standard business offering is about $150 per year versus Zoom starting at about $150 per year. It's tough to compare the services that they offer, but hey, their business plan is about $200. Their business plus plan is about $250. So as people look at this, as you know, high level people in random businesses look at this, is Zoom providing more of a value at their price point than companies like Microsoft Teams, companies like Google, which their Meet product, etc. There's certainly going to be more pressure on Zoom than there was before, and you can kind of see why their growth is slowing. It's not only that companies are returning to the office more so than before, and maybe they don't need as many Zoom licenses as they did before, and or companies are moving to other products that may be similar in service and or cheaper at the same time. For example, our company, which is a large Fortune 100 company, basically, we did use Zoom at the very beginning of the pandemic. Now we are all on Teams because of the integration with all the other Microsoft suite products that we use and the ease of use there. I think in general, Zoom might be a slightly better product in terms of video fidelity, etc. But Teams provides similar things at a reasonable price point, even a better price point. So growth is good in the Americas, slowing outside of the Americas. Usually what you want to see anyway, because margins in Americas are probably going to be better than outside of the Americas. But since it's a much smaller piece of the pie, you would think that there would be some headwinds in America and tailwinds outside of the United States simply because of the size, but that's not the case. That does kind of limit their growth potential if they're already starting to shrink outside of the United States while having a much smaller revenue scale there. Looking at margins, revenue growth, like I said, 4% over year growth, pretty decent. Very good gross profit. But then if you look at their expenses, we'll talk about that soon, relatively high, and their diluted EPS only 59 cents. You've got non-GAAP EPS, which they really hang their hat on at 134, but there's some non-cash expenses that are taken out of there, but that really, should be expenses because the biggest issue here, as I look at their financials, is the stock-based compensation. We'll talk about that soon. But let's kind of finish up with the review of the earnings. Decent growth on the revenue under contract, strong cash flow, and this is a company that has been very cash flow generative, which means they essentially don't spend a lot of money on a lot of stuff. This is a good margin business on the free cash flow side, talking about almost 300 million in free cash flow in one quarter, which is very, very good. They're generating over $1 billion in free cash flow per year, which leads them to this $6 billion cash balance that they have, which is very solid for a $20 billion company. Growth outlook here, maybe growth of about 2 to 3%. Weighted share count kind of going up a little bit in the third quarter, and a non-GAAP EPS of about 463. So when you compare that against their price of 67 bucks, that's pretty decent from a PE ratio. Don't really look at it that way, but that's that. Let's look at their financials here. As you can see, the stock itself has tanked so much in the last couple of years. If you bought during the IPO, you're basically flat. These guys do not pay a dividend, so you're basically made no money during the IPO. It's essentially at all-time lows at this point. It's sort of where it was at the IPO. Since then, it started rising. It exploded during the pandemic. Like I said, peaked out at $530. So my apologies to anybody who bought it right around there because you are down a lot. If you go back through a 3-year basis, it's close to, down 82%. If you go to the peak, it's probably close to being down over 90%. Yikes, yikes, yikes. So now we're down to 67 bucks. Their earnings report didn't really generate a lot of traction. It was kind of around here. It's sort of flat since then. Why is that the case? Why is this company doing so poorly? Well, the main story here is that the financials have basically slowed to a dead crawl. They went from, 100% growth year over year to 300% growth in 2021 during the pandemic, still good 54% growth in 2022, and now into fiscal year 2023, they were only up about 7%, and now the projection for the next year is maybe 2 to 3% growth. A lot of that growth was priced in at that $500 price point, so when it slowed down, the valuation came back down to earth. If we look at the estimates going forward, valuation is kind of reflecting the fact that the revenue is going to slow down to 7% growth last year, like I said, 2% growth this year, and then maybe an uptick based on the projections we're seeing here. I don't know if that's realistic. The company is still doing a good job in recognizing high margins from the revenue they are collecting. Obviously, the cash balance they have has been built up because they were able to generate free cash flow for the last couple of years. They haven't really spent it on much. They haven't done a ton of buybacks. They've done some, but in general, their share count has gone up in the last couple of years, but they do have the dry powder to do something. They did try to make an acquisition in 2021, try to acquire Five9, I believe, for about $15 billion. The Five9 investors at the time said, no, thank you, sir. So the acquisition was scrapped. I think Five9 is now worth about $5 billion. So they kind of fell in line with Zoom. That was going to be an all stock transaction. So I think at that point, the Five9 ownership and investor group was probably like, well, this stock is not going to hold up in value. We do not want your overpriced stock for our overpriced stock. So at the end of the day, I think the acquisition was the fact that it was scuttled was maybe a good thing for Zoom because maybe the growth there would have been slightly helpful, but they certainly would have had an overpay on their hands and further dilution. Maybe it would have been a good thing since their stock was so overvalued, but who really knows? It didn't happen at the end of the day. Beyond that, they have acquired some small add-in, tuck-in acquisitions here, but nothing major. So they certainly have the opportunity to do that with their market cap being at $20 billion and $6 billion in free cash on their books without really any debt. So as we look at their analysis here and what this stock is priced at, a couple of things to point out here. The key thing is that they are generating cash flow, but margins are shrinking a little bit and revenue growth is starting to slow. Now, the expectation is that, yes, it slows into 24, maybe starts growing again. The expectation on the margin side is that, yes, it shrinks in 23, maybe stays static in 24, but then starts growing again. Don't know if that's optimistic or not. We will take a look at that. But at the end of the day, today's price point at 67 bucks and 70 cents prices this to about a 20.3 billion market cap. When you take away the 6 billion in cash, it's about a 14.4 enterprise value, which at the end of the day, based on the market cap, is about a 5.8% free cash flow yield, which is decent, right? The risk-free rate today is in that 4.5 to 5.5% range, depending on how long out you're looking. So when you're looking at something that is probably going to continue to grow their cash flow yield, that is paying a bit more than the risk-free rate, that's not bad. But maybe with growth slowing and margins contracting a bit and competition being out there in a bigger way, you would want something a bit more than that. So that's something to keep in mind. If you believe these factors, if you believe these free cash flow projections up to the fiscal year 2028, so a 5-year outlooking period, considering 0% in buyback, basically buying back 0 shares, and I'll tell you why I have that assumption there. You're looking at about a total annual return of 8.9%, a total return of about 53% 5 years from now, if the free cash flow yield stays the same. I think if the growth is slowing, the free cash flow yield maybe is a bit optimistic. So you're looking at something higher, 6 to 8%. You're looking at that 2 to 8% annual return. If you, for some reason, believe that you can get a better deal than today as far as valuation goes on the market, you could certainly make a case for a higher return. Now, let's talk about buybacks. You would say to yourself, this is a company that has $6 billion in cash. If you look at their financials, let's go back to their financials, go back to their free cash flow here. You can kind of see, well, they bought back, one second, let me find it. They bought back $1 billion in shares in 2023 fiscal year, 40 million in 2022. For some reason, they're not really buying back as much in the last 12 months. If you look at the last quarter, they actually didn't buy back any shares. Why wouldn't you think that they're going to buy back more shares in the future? Well, the problem here, and this is Zoom's big problem, is that these free cash flow numbers are driven on the backs of humongous stock-based compensation in the last couple of years, and stock-based compensation that has been growing. And stock-based compensation is basically a non-cash expense. It's companies issuing options and stock grants in lieu of higher salaries. So it's a way to retain employees, giving them stock grants, etc. It's a non-cash expense, so companies like it because they don't have to spend any money today, but it does dilute their shareholders in the future, which is not a good thing. So they are issuing 1.2 billion in stock-based compensation, basically 1.2 billion in future shares. Now, some of these may not be realized if they're options with terrible strike prices, etc. But at the end of the day, it's probably some sort of dilution and not really offsetting that with their $1 billion in repurchases of common stock. So as we look at the latest couple of quarters here, we want to see if that's continuing or if that's stopping. You can kind of see in the first quarter of 23 or the last quarter of 24, it's 518 million in stock-based compensation versus no repurchases. It's 282 million in stock-based compensation versus no repurchases. it's 261 million in stock-based compensation versus no repurchases. So they're keeping this cash on the books. They're generating this cash by not really paying higher salaries, by making sure that employees are being paid with stock-based compensation and diluting future shareholders, but not buying back any shares to offset that. So essentially, you're diluting employees. If anything, based on latest trends, you could make a case that buybacks are going to be negative, that they're going to have more shares by 2028 than they have today if they continue doing what they're doing, in which case their return is even worse. Right? So that is a problem. That is a problem that management needs to fix. And that is also a problem if they want to retain talent, because stock-based compensation is a good way to retain talent if it has value. If people start thinking that your shares are worth less than they are today, they're going to just demand higher salaries and or go to other companies that are paying better salaries and or have better growth potential, which means that their stock-based compensation is going to be worth more. That means that they're going to have a harder time retaining employees and retaining talent, and that is a problem. If you look at the last 5 years, they have, in essence, issued 3.8 billion in shares because their stock-based compensation is so much higher than what they have bought back on the share side. So management has to do something about this. I think management has to either cut back on stock-based compensation, which is going to be hard to do if they want to retain talent, and or start using a lot of their free cash flow and cash on the books to start offsetting, not only offsetting the stock-based compensation that they're issuing, which is, 1.2 billion a year, which essentially eats up most of their free cash flow. How about that? And then also buy back additional shares to drive further value, because this is going to be a problem for them, and this is going to be a problem for all investors as they get diluted throughout the years if this continues to be the case. And for me, the reality here is that this growth is potentially unrealistic, right? If I go back here and I put in, let's say, maybe this company is kind of at its peak. So growth is either going to come from some sort of transformative acquisition, which I can't really price for, or maybe development of products that make Zoom so much better than everything else. And I don't see that happening because Teams is almost as good and cheaper. Google Meet, haven't really used, but certainly has value. There's a lot of competition out there. There's going to be putting pressure on growth here. And as employees go back to the office, as companies are less dependent on these types of products, maybe the growth here is something closer to 3%, right? And if the growth here is something closer to 3%, if pricing pressures forces margins to stay the same, you're looking at about a 2.9% return at today's prices with yields staying the same. And the reality is if growth continues to be anemic, yields could get worse, which could make this a negative return on a go-forward basis. So this is a tough one. This is a tough sell for me. Basically, what I'm saying is that I would need something like a $45 price point here, which is 30%, 33% lower than it is today, to sort of make sense of a maybe a 7% return on a slightly lower free cash flow yield at this growth level. So if you believe that growth is going to be anemic and there's going to be pressure on margin, today's prices are not really that great a deal, right? Because you're talking about something that is going to start to slow down in growth. And if rates stay elevated for an extended period of time, this valuation of 5.8% on a growth rate that's maybe 3% with shrinking margins just isn't that interesting. If it was at $45 or at $40 to make this 7% yield closer to 10% a year, maybe I'd be interested, but that's a 40% fall from where it is today. And I think a lot of the problem here is also driven by the fact that every time you look at these shares, you have to think about the fact that 5 years from now, I may be more diluted than I am today with what management is doing. Because what are they going to do? Are they going to lower the amount of stock-based compensation they offer when their stock price is lower? And if anything, if they continue making it as high as it is today, each dollar they offer based on today's prices is going to dilute you more than it did 2 years ago, right, when the stock price was a lot higher. And that is a problem. Yes, they're generating a lot of free cash flow, but that free cash flow is generated on the back of stock-based compensation, right? Because when you go to their actual bottom line net income, which accounts for the stock-based compensation because it is a real GAAP expense, it's 103 million, and then you add 1.2 billion of stock-based compensation, which is almost all of your free cash flow. that's a bit of a problem. So if all of your free cash flow is driven by stock-based compensation, the non-cash expense, what would happen if suddenly your employees value stock-based compensation a lot less and you have to pay them a lot more to retain them? Your free cash flow could plummet, your margins could plummet because you're using that stock-based compensation to kind of juice your free cash flow margins because you're essentially trading a salary for stock-based compensation, right? You pay your employees less and give them more stock-based grants. But if suddenly your stock is worth less and less and less and less all the time, your employees are going to be like, well, I need more money. And that is a problem that this company has to somehow fix. So there's a couple of ways to fix that. Obviously, juice your growth somehow, some sort of acquisition. You do have a lot of cash to do that. Second solution is to continue doing stock-based compensation, but start buying a lot more shares back. If you start actually reducing your share count, where your buyback is, maybe 25% of your actual free cash flow. And that is on top of the stock-based compensation. So you would still issue, let's say, $1 billion in stock-based compensation a year, but have to buy back 1.6 billion in shares to at least sort of across this 5-year period buy back some shares. This could have a lot of value creation for your stockholders, right? Because at the end of the day, when you're diluting your stockholders with low growth, you are not creating value. So they have to do two things in my mind to right this ship. They have to figure out a way to fix that. They have to start buying back shares with the cash um, on their books, because right now they're basically saying we don't think our stock is valued that much. Why aren't we buying back shares? What are we doing with this money? Yes, it's it's probably giving them decent income, honestly, because 6 billion in cash is earning some decent interest at this point. But they have to feel that they could probably get more value out of their shares by buying some back at least. And I don't know if they have a share buyback plan in place, but they certainly haven't been doing that in the last couple of quarters, which is a bit disappointing. They have to do something with this cash that starts to create value for shareholders. Otherwise, the stock price just doesn't seem like it's headed in the right direction. I just don't see the value here. What's the story? Growth is shrinking, margins are compressing, they are diluting shareholders every quarter. They have a bunch of cash, which is great. So maybe you're saying, well, you're not really giving them any credit for the fact that their enterprise value is actually 6 billion less than the market cap. You're pricing everything based on the market cap. Sure, but I'm also punishing them for the fact that they're diluting you every second of the day by issuing a bunch of stock-based compensation and not buying back any shares, not doing anything with this cash. So until they do something that changes this path where they're continually diluting, continually shrinking margins, the growth isn't really there. There's competition that is going to eat into some of their margins potentially. They have lower pricing. I don't know if these guys have a ton of pricing power, right? If they raise their fees a ton, will the enterprise customers stay or will they just go somewhere else? Yes, there's some data that shows that they're renewing people at a decent clip, but and actually getting more money each time they renew people. But I don't know how long that continues. Certainly, if we go into a recession, some easy costs to cut are here. You go to somebody cheaper. You make calls on Google Meet. You have meetings on Microsoft Teams. A lot of people use Microsoft products already. It's easily integrated. That's why we made the switch as a company. I'm not in charge of that, but that's what I think we did. And Microsoft Teams is pretty good. It's not amazing. Video fidelity isn't fantastic, but it's pretty good. And if it's cheaper and it's all integrated within a product suite that you already use, that's a problem for Zoom, which is kind of an outside vendor. And yeah, they integrate with a ton of apps. They do a good job on that front. But obviously, their growth is sort of behind them. There's possibly some upside. Hey, maybe there's an additional lockdown. I really hope there isn't. I really doubt there will be. But they really need something like that to spur growth. They really need some sort of new products to spur growth, to juice margins. And they probably need to at least think about making some sort of growth-related acquisition if they want their stock to continue to rise. Because just based on what I'm seeing here today, and these aren't even like bearish assumptions, right? These are reasonable assumptions based on what you're seeing today, and you still need a price of like $40 to make me feel comfortable about the return I would get to invest in this case, which is 40% lower than it is today. And that's mainly because there's a lot of negatives I see here. Yeah, they have a lot of cash, but they're diluting you. Growth isn't there. Margins are shrinking. A lot of competition. And not really doing any sort of buybacks. I think as the price falls, if the price falls, I think these guys need to buy back a ton of shares if they're not going to make an acquisition. If they're issuing stock-based compensation that is going to dilute you in the future, they need to at the very least, offset that. The very least, and they're not doing that, and that's a problem to me. I think that's a problem for investors, and I think until I see something different here, I am just not that interested in Zoom at this price point. Even though it's it used to be at $500. There's maybe potential here if growth starts to pick up again, if people start to use this product more, but you really haven't seen that in the earnings, in the estimates, in the projections. They're not really saying anything or doing anything that makes me think this is a beautiful investment. And the base case here isn't all that enticing. And the bear case here is that this is going to get a lot worse if growth slows even further than what we're showing here. Even with these estimates here that are probably optimistic, you would still need a price point at like, if you want to make a 7% yield work at like $52, right? Which is way off today's price. Not all that interesting. I don't love it. Let me know what you guys think about Zoom. Hope you enjoyed this video. Let me know what you thought about it. As always, I am not a qualified financial advisor. Please do your own due diligence before making any investment decisions. If you like the video, if you're still around, hit the like button. Hit the subscribe button to stick around and watch more videos. But thank you for watching. Hope you enjoyed it. And leave a comment down below to let me know what you think.